Forex market, if we try to understand, Forex market is dealing with the concept of exchange rate. Let us understand, since we are doing very basics here, we should understand exchange rate, the rate at which a particular domestic currency is exchangeable with the other currencies of the world. And that is what is where one sees three major approaches of foreign exchange market. One way that we can exchange it is a flexible exchange, that we can call it. Flexible exchange is one in which we have got the currency is floating in nature, shall we say. When we say floating in nature, that means the market forces of demand and supply, they basically determine the value of domestic currency. That means when there are more demands of import, there's more demand of the foreign travelers and they want foreign exchange. The demand of the foreign exchange goes up, and then of course the domestic currency value goes down because the demand for foreign exchange has gone up. And the simple principle of demand does apply here also. Then when we look at fixed exchange rate, which means the country is committed to maintain a particular exchange rate for its domestic currency vis-a-vis any other currency or a basket of currency to which it is pegged. And that is a fixed exchange rate that we have got, also referred as pegged exchange rate. And that is where the central bank plays the most crucial role, ensuring that irrespective of demand and supply of the domestic of the international currency, the domestic currency holds its ground, whatever promised ground that it has got. Then the third is managed floating. Managed floating or dirty float, quite often they refer this word, where you have got a mix of the two which is there, which means it is certain extent within certain band, it is allowed for the market forces to determine, and subsequent to that, if it goes beyond a particular level, then in that case, the central government, a central bank would definitely put in and then come into this and then would try to ensure that it stays within a particular band that it has got. And I would like to tell you that demand and supply system works here, but there are a lot of unique things which happens, which you will get to learn in due course of time. If you want to do some task on your own, try to learn J curve, how the J curve balance of payment operates on a short form. Like you will find the balance of payment initially when the domestic currency is going down, goes down. But over a period of time, you'll find that it stabilizes and then actually balance of payment improves. Because what happens, if you do devaluation, then in that case, the domestic currency becomes weaker and the exporters would find a favorable ground because they will make more money for whatever simple amount that they're exporting. But importation will become difficult. So the supply of foreign exchange increases and the demand of foreign exchange goes down, and then that initially depleting balance of payment will start showing in long-term basis an upsurge and then taking a shape of J curve. It is an interesting concept. I'd like you to research a little more on this. You will get a lot of insights on it, and that definitely operates in an economy that is operating there.